Hello, everyone. Welcome back to the weekly meeting of Trend Following Trading Club. It's been a very tough week for some of us. Tough month. Worst month I have experienced since all the good months started back in November of 2020, for me at least. So the long-term classic, really, really bad. Everything is working better. So hopefully, can't wait for this month to be over. And hopefully next month will be a lot better. But I'm interested in how it's going for everyone else. And hopefully better than for me. And so if you have any comments or questions, let me hear them. And let me know if you want to speak. Try to keep your comments to about a minute or so we can get a lot of people in and keep everyone interested. We had some good tweets this week. Rich was on fire with his tweets. I really enjoyed reading all that wisdom. And someone got us going on the party analogy of should we go to the party early and stay late, or go late and leave late. Yeah, that was my idea. Go to all the parties late, leave late, see what's happening. Unless it's a loser party, then we can, like a losing trade, we can get out of it pretty quickly. All right, well, I'll try to invite Oleg, but maybe he's having some trouble.
Enjoying the West Coast. Is this a holiday?
Not quite a holiday. It's a little bit of pleasure and work. Very short trip here to Portland, Oregon. I've never been here before. It's a nice place and nice people. And I was very happily surprised with the food. Very nice restaurants, a foodie place. And of course, the wines are amazing with the Willamette Valley, the Pinots. So a lot of fun here. Unfortunately, I'm not staying that long. And it is 5:02 a.m. on the West Coast, but I'm still on East Coast time. So getting up at 4 a.m. was no problem because that's what time I would have gotten up today at home. So don't feel sorry for me. I'm in good shape.
Welcome to my world. So I was slam dunk this week, particularly this week with my portfolio. So my energy's got a significant bruising. So yeah, I was down significantly, and I've just decided I'm not going to actually measure the damage until the end of the month. And I'm crossing my fingers that the last few days, work out. But it's been a pretty crippling month. But I suppose we've had such a great ride for so long, it inevitably has to occur. And I didn't want to jinx anyone. Someone suggested I jinx them on Top Traders Unplugged when I suggested that we hadn't experienced the give back. But as soon as I mentioned that, of course, the markets went south. So, I think I've paid the price for that statement on Top Traders.
Yeah, I'm very wary of making too many comments about how good performance is because I don't want to jinx it. And so I try not to say too much. But I was hoping for the last 3 days, then last 2 days, and now we're down to the last day. I'm not sure it's going to matter very much. But today's right after this, I need to sign off in an hour and a half because I'm going to do my Top Traders Unplugged with Niels today, right after this, due to both of us traveling. So hopefully the Wi-Fi here in the hotel is going to hold up. It just came back on this morning. And but if you have any suggestions on topics, anybody, let me know, because I'm a little distracted this week as well about what kind of topics Niels wants to talk about.
That Morgan Housel article was fantastic that you tweeted this week. It was just the other day. And really, that just complements what we've been saying during the week. It was a marvelous sort of end to that discussion, talking about the dominance of outliers and that every one of the big things that happen in our lives is a tail event. And it was just it really struck a chord for me.
It's always good to get people from outside CTA business and trend following to confirm our philosophies and beliefs. It's always fun, and especially for them to put a little twist on it. It's a little bit different than the way we think. I've heard that Buffett quote before, that something like, if you take away my 10 best trades, my 10 best decisions, I really haven't made much money. So yeah, we're all kind of subject to the tails, positively and negatively. However, the trend following seem to vol manage and do their best to not let the profits run and not have the tail events like they could, then they tend to survive and do fairly well. So maybe not everyone is dependent upon them like you and I are. We've put ourselves in that situation on purpose to get the most, and sometimes the most painful, volatile, because all of these trades this month, of course, every one of them are just incredibly profitable trades. Incredibly profitable trades. So it's just a little bit of give back. And then we have implemented a super conservative money management scheme using closed trade equity, or something that's a far smaller number than total equity. So that's helped us as well.
Actually, it's very interesting because when I did that series of tweets that talked about how you can have the bulk of your distribution of trades, 90% of them basically representing minor variations, and it's only that 10% that represent the real cream. That's really that Buffett statement, just detailed in our terms. And when I for instance look at, say, the monthly returns of any of the trend following indexes, or the monthly returns of any of the trend following programs, if you're looking at, say, a 20-30 year history on a monthly basis, and you strip out the top 10 months of that, you effectively get a break-even result, which just demonstrates that the entire performance of the trend following is just dominated by outliers. And that's why I mentioned in that tweet, I said, if, for instance, we paid strict attention to that 90% of our trades, and really worried about that, we could get ourselves into all manner of strife. And I think that's where we probably depart from people that exercise, volatility targeting, as our focus is really dominantly focused towards the outlier, and it's not focused towards trying to extract edges from other parts of our distribution. It's not to say that there can't be an edge extracted from there, but it's saying that because most of nearly all of our cream comes from those outliers, why invest that effort and research to potentially compromise your position by focusing on that 90% of trades, when really, in the scheme of things, they're almost random variations.
Hi to everyone. Very happy to be here. It's okay with my microphone now, I hope. I want to say that I'm very happy to be here, as I always say, and I'm waiting for these happy moments for a week, maybe from Monday at least. And I want to say that in general, when we are speaking about business, about sales, maybe it's not a very correct analogy, but sales manager in a big company, for example, he have maybe 60, 70 calls, cold calls or cold emails a day. So maybe in a month it's near 1,000 calls, and maybe only 10% will be clients, and some of them will be a long-term clients. So not very correct analogy, like I said, but maybe I see the same, some kind of the same principle, that most of the attention that is paid for this is maybe small losses of the time, but some of the clients will bring all the profit.
Yeah, I agree with you, Ollie. I think almost everywhere you look, you see this impact of. A lot of people refer to it as the Pareto impact, the Pareto influence, and you just find that whatever you're looking at, the dominant change is created by the small percentage, the 2, 3, 5% or whatever of those trades. I know it's not an exact science when they talk about the 2% Pareto principle, but what we're talking about is similar. 5%, 10% of our trades make all the influence over our long-term prospects. So yeah, it's a very important principle, and one that is sort of aligned with this principle of complex systems, where you get one relationships. There is not a sort of a linear relationship between change events. They're often non-linear. They're often driven by power laws, and it's those events which are the game changers, either in terms of the profits that you generate or in terms of the risks that you accumulate if you don't take them seriously. So, yeah, I just see it everywhere.
I'm a big fan of universal principles because for me personally, when I see that the principle is universal, then we can apply it to different fields. It means that it's true principle if we can apply it to different field. And if someone said, for example, that he knows a secret of a particular market, that in a particular time frame he knows how to do a super secret trade and it will give a lot of money, I don't believe it. I see that it can be maybe even if we can say a long track record theoretically of that, it can change in every moment. But if we see a universal principle, we, as we all say here, at least it's a lot of sample size, and at least, and I see how the trend following principles work in sales, when it works even maybe in some relationship between people in business, even in nature, and it gives a lot of more confidence in them, in our philosophy.
Hi guys. This week on the short-term trend space, actually this month, I'm just flat. So June was a good month, and July is, I'm 0.5% up or 0.5% down as we speak. But just to give you some indication, for instance, I am up on the beans, making money on the beans, making money on some of the indices. I'm possibly making money on the copper, high-grade copper. So not an exciting month, and it's also important to understand. Maybe sometimes we are even though I'm a short-term trend follower, maybe we are less of a correlated. If you're losing money this month, for instance, I didn't lose a lot of money, and my drawdowns this month was somewhere else between 4% to 9%. So actually, at some point, I was hoping to see more than 10% drawdown because, if, as Oleg said, if the total amount of drawdowns are not exceeding a certain limits, so it just suggests that the market activity is muted and the potential to upside is also going to be muted. But we'll see what will happen August. Thanks a lot. Cheers.
Yeah, well done. You've obviously done very well. I was sort of down at, I think when I last measured it, around 10%. So I was absolutely hammered this month, but I think it has come back a bit. I'm just hoping that it comes back a bit more. It was interesting, Jerry, the Howard Marks memo you put up this week. And when I read it, I love Howard Marks's works and his memos, and it really makes me think about the similarities between his style, which is deep value investment, I believe, and our style, which is classic trend following. And I've often commented about how both of the approaches we adopt the counterintuitive method or process, but I think Howard adopts a counterintuitive mindset, whereas we adopt the counterintuitive process. And commonalities of this counterintuitive nature seems to sort of fit in with that Pareto principle we were just talking about, in that if you are counterintuitive and you are right, then the flow of money's towards you, because you are a small sort of segment of the market, because most are wrong, being counterintuitive, that the flows come to you. And I tend to think there is a correlation there between outliers, tail events, and this counterintuitive process or mindset.
I like reading Howard's memos as well. A lot of the time, I have to really pick and choose though, because he disagrees with. I'm pretty sure he'll say things like, "Never buy just because it's going up. Never sell just because it's going down." So there are limits to how much we agree with, because we're doing two very different processes where we're trying to trade as many markets as possible, take the smallest bets possible, and only buy because it goes up or sell because it goes down. And we're going to limit those losses. And Howard has quite a bit different strategy, but he still has some good wisdom on generally how he does things. And they have a tendency, like Morgan Housel, to kind of sometimes agree with the way we're thinking, the way we do things. But, one of my pet peeves is this whole idea that it doesn't matter what you do. Everything's created equal. It's just your choice. If it works for you, you do it. I don't agree with any of that. I never have, and I never will. I think there are obviously people who say that there are lines that if you cross it, they would not agree either. So it's I think trying to in this memo, Howard, the part that I tweeted was him saying, "Look, life. This is hard work. You have to look. If you're not willing to look like you don't know what you're doing for long periods of time, like July for the trend followers, then maybe you're not cut out to do this. If you've got to tweak your system, if you have to make it just so you can handle it, and so it fits your personality, then maybe you just shouldn't trade at all, because maybe you're not equipped to look wrong and absorb pain. And I'll tell you, if you want to do it right, you want to maximize these outliers, you're going to have a lot of pain. And for me to say, oh, all of these trades are positive, they're all profitable, and so let the profits run. Don't worry so much about these drawdowns and having a bad period and relative performance. Oh my gosh, that's even worse, right? If we were all losing money, but a lot of these other trend followers reduce positions near the lows in some of these markets or the highs because of volatility, and we're going to look a lot better than the classic this month. So all of this is really painful, regardless of your strategy. What I say is not necessarily what I feel. I want to say the right things, but I'm human, and so I don't feel good. And when you're in some of these trades and you're still long, there was an embarrassing comment on last week's Top Traders where Mark was talking to Niels, and he said something about a position that he sort of insinuated everyone is short this market, and I'm too embarrassed to tell you which one it is. And he goes, everyone's short, and I was like, oh crap, I'm not short. So I'm like super long term, and it's really painful, and I don't like it. But you're really sitting there going, are any of these trades going to turn around? I'm getting crushed in every single one of them. So the back test says, yeah, don't worry about it. Overall, over the whole test period, it'll be fine. Some of these trades, they get volatile, they sell off, and then they reverse and go back to new highs. And you maintained your position. You maintained the original ATR. You've got this huge, great position on, and you're going to make a ton of money because you were patient. And if the back test didn't confirm it, we wouldn't do it. But we kind of want it to happen in July. And, or this year, or on these trades. We don't want to wait until next year while we really stink this year. Yeah, especially relatively speaking. I hate being the worst performer, but I'm sure that goes with the territory of successful trading. Any way you do it, at some point in time, you're going to be the worst over a short period.
And I like these ideas very much, and I want to say I fully agree with Jerry that people think too much about their own personalities nowadays, and maybe in all fields, a lot of fields, with people with their own uniqueness, own personalities. Yes, I agree that every person is unique, but we have some rules. That is universal rules of nature, as I say always. And for example, one friend of mine, he is a lawyer, and he told me how he came to a court coroner and asked him why did he made a particular decision. And that guy, coroner, he said, because I have my opinion. It's based on my opinion. And this lawyer said to him, you don't have a right for your own opinion. You have a law. You have laws, and your opinion must be based on a law. But you have no right for your personal opinion in this case.
That's interesting, Oleg, because I agree every individual has a unique knowledge, a unique mindset, which is sort of based on what they've learned, what they've experienced over the course of their life. And in the mind of each individual, they're all different, and therefore they pass the information in a different way. And I often think that thinking is very much like a process of optimization that I do on my systems, where if you think too much about something, you over-optimize your behavior or your response. And I see this in my when I'm doing my system testing, when I'm dealing with complex systems versus simple systems, and I think the mind does that as well. So I prefer the ability, recognizing this sort of deficiency in each human brain in their thinking. You can sort of use a rules-based process that is empirically validated, which basically tests the rationale or the coherence of your thinking, and I think that really helps. And I think with our trend following models, that's exactly what we do. So whilst our opinion and our thoughts are uncomfortable often in the trades we take, we're not making decisions based on our thoughts. We're making decisions based on a process that has gone through a rigorous method of processing to come to a definitive conclusion. It's not really a law as such, but it's certainly striking a much firmer foundation for decision making than what the human brain can conjure up.
I have heard, maybe I have read, I don't remember now where, but if one guy said that if we do such an experiment, for example, we will take 30, 20 or 50 guys from a street and we'll give them opportunity to trade. And the decisions, he said, of that guys will be decisions that will ruin most of that guys. Their opinion will ruin all their accounts. It will blow up all their accounts. So this our opinion here must be, as I said before, must be based on very disciplined rules and very good rules. And people, of course, every person wants maybe the best for himself, and maybe some I saw investors who wants 20 or 30% in a month without a drawdown at all. And if somebody will say that he will give them such an opportunity, that people believe this, and it's not a good situation. It's not a good situation for the world of finance in general, I think.
Hey guys, I hope you can hear me. It started to connect me here when I put the mic on.
Yes.
All good.
I'll use the chance to ask Richard. I enjoyed the last podcast episode on Top Traders Unplugged, and there you spoke about your backtesting process, that each year you add the latest data of the ending year to your backtest sample size. And I was just thinking then, if you pay more attention to the latest data and the latest year, or you put like equal weight on all the years in your backtest sample size. For example, like you told there that in your example that you add another year, now you have like 41 years of data. Like, do you put more impact on the latest year or years, or you treat them like equal data? Thanks.
Yeah, Marcus. No, it's just an addition of a year to increase the sample size for the backtesting process or the testing process, which is sort of like a validation of my hypothesis. So there's no sort of extra weighting applied to the more recent years. What it does is it's just it's assessing each system on robustness principles across the entire data set. So if I've got 30 years and then an additional year comes, I've got 31 years. And all it's doing is it's always assessing the robustness. And when I say assessing robustness, because I'm looking for these outliers, I'm looking for a fairly small sample size per return stream, because I don't want to participate in what I refer to as the normal area of the distribution of the market distribution. I'm only focusing on outliers. So I have a fairly small sample size, but every bit of additional data is valuable to me because I have so few outliers in each system return stream that an additional year might mean an additional extra outlier for that return stream, which is all the more valuable to me. And it's also valuable because what I find when I test for robustness, if any of the systems collapse, and when I say collapse, I'm talking about in terms of their adverse risk exposure. So I'm really only looking at the adversity side of how they perform, because all of my systems have open-ended profit potential. So I don't have to worry about the profit potential and their ability to catch the outliers, but I do have to worry about protracted market conditions of mean reversion and protracted market conditions of noise. And the greater the sample size, I find that the more I can exclude those conditions. I hope that helps.
Got it. Thank you.
Joel here for I don't know if you guys are hearing me. So lately I've been trying to test trend following systems on short positions. I'm using already trend following systems for long on indexes and shares. And one of the problems that I've come across is that even tweaking the systems, the maximum I can't, I cannot generate a positive expectation for in the short terms, either for shares or for indexes. I don't know if this is a problem of basically I'm breakout don't change channels. I don't know if this is a problem that only I am coming across of you guys are feeling this, that the short positions for shares and indexes, they don't have a positive experience unless it happens by chance. Meaning even if the S&P 500 and Nasdaq, if I short the breakout from the bottom of the channel, only if I use asymmetrical channels for the up and the bottom, I can get a really small positive expectancy. I don't know if you guys come across this problem or is something that you discuss and I'm not aware of.
And I think it is a problem. Everybody probably runs into it to one degree or the other. Obviously it depends upon the type of system and the money management and the look back period you use and your trading and your stop loss. All of that's going to give off different results, but suffice it to say, the longs are so much better, and the shorts might make a little bit of money. I think that if you look at all the data, which I'm totally in favor of, the way Rich explained it, commodities and currencies, bonds, interest rates, I'm pretty sure the shorts make money, but I'm pretty sure the stocks don't. Short stocks in general doesn't make money. And short indices, I think, should be okay as well. But it's so small. And so you start asking yourself, why do we even trade? Why do we even bother with these shorts? And I think, obviously, well, there's a couple reasons. One would be diversification, which, as long as the diversification doesn't get in the way and limit the way we hunt the outliers and maximize the profit in the outliers, we are appreciative of that diversification. I think you can never rule out the possibility that shorts could get a lot better in the future. And when we test the shorts, we need to test the shorts and trade the shorts with the same systems that we trade the longs, so we can double our sample size. And then we should take the average trade of the longs and the shorts and deem that to be our expectation per trade and our average win or our average loss and our win percentage, and not separate the two out. So I've tried to limit the shorts in a good, reasonable way, and I think it's possible, but you probably don't want to get too many filters and get too uptight about the shorts. They also have a tendency to do well when the longs are doing very, very poorly. Now, I think in some of those extreme periods that I have in my mind, especially the recent ones, 2020 and maybe 2008 and maybe 2018, some of those periods, the shorts did incredibly well, but because in a short period of time, like a few months, the longs were so bad that it really made the performance much better. However, the short trades during those periods did not end up being great trades, So that's okay, right? So it's peace of mind and relative performance and the things that help us sleep at night. The shorts are good, and we should like them. And I do think the smartest person I ever met in trading, who told me one time when I was talking bad about stock shorts, he firmly believed that they could get a lot better in the future. So you can never rule out hope that crazy things can happen in the future. And I don't think he meant crude going negative, but things can get better, things can change, and that's part of trend following, and part of how we approach the markets. And we don't make these assumptions that, other than a good entry, a good exit, and a good stop loss, that's pretty much what we believe the history is telling us. The back test and the historical data is not telling us what the future possibilities are.
Yes, and I remember how Neil said that we, I remember he said in one of the episodes of Systematic Investor that we don't know what the future will bring for us, and because of that, we trade shorts. And I agree that we don't know. It really can be theoretically that shorts will doing very good in the future. I think so.
Yeah, it's interesting. When I do my back tests, there are frequent times when I do my back test and I say to myself, well, if I only had shorts on these indexes or these whatever commodities or whatever, if I only had longs on them, I'd have done a lot better. But what changes my mind is the impact at the portfolio level when you trade both long and short. So if you're trading only longs, and let's say your systems that you have in your portfolio only allow a certain number of trades per market or one trade per system per market to be active at any one time. If you've got both longs and shorts happening, what you find is it forces a level of lower correlation into the portfolio than if, for instance, you are trading only long-only positions. So sometimes we do things which, strike us as being, a bit strange, but there is a deep reason for why we adopt both long and shorts, because it's not just the performance of each individual system. It's how they all interact together at the portfolio level. And having both long and shorts certainly does reduce the level of correlation that exists in your portfolio.
And I think I want to say the following thing, that we apply universal rules. As we always say, we apply universal rules to all the markets. And we see on commodities markets, on currencies, commodities, on bonds, we see that stocks performs very well, very good, and shorts performs. And only in the stock market, we see that 90% of a profitable trades, as I know, is a long trades. But we apply universal rules, so this is the evidence, I think, that shorts perform very good in other markets. And in the long term, we know that all markets are the same if we are talking about them. How they're structured, in what things they are based, they're the same in the long term. So I think this is the evidence that shorts are doing well in all other markets except bonds or stocks.
And also the risk profile is much better, isn't it, when you incorporate shorts? In the Top Traders Unplugged, they were discussing about this systemic risk last week. And, your overall systemic risk exposure is much lower if you have, some short position. So you wouldn't want to be. So, when I open up my 30 positions, I really am looking for, 5 to 10 short positions among the entire portfolio. And I can sleep better at night knowing that, if something else happens, these positions are going to go to the other directions, really. So, yeah. And if I'm not mistaken, this was the view that has been taken when Jerry Parker was trading with the turtles. So the original turtle rules has actually give weight to be able to trade short and longs. But Jerry can correct me if I'm mistaken. Thanks.
Oh yeah, I mean, I still believe all the original turtle rules. So yeah, whatever the shorts, we traded a lot of shorts, and two things I'd say. One is I don't think it's profitable from a systematic trend following point of view to think of shorts any differently than longs, and then to never think or say or let it get into your systems that shorts have different patterns or different. Everyone knows shorts behave differently than longs, blah, blah, blah. No. I mean, historically, maybe, but we need those shorts to be traded with the same systems as the longs for the sample size. And we don't want to be tempted to try to over-optimize on half of our trades. And, people are always saying, like, why don't you just add something to the trend following to smooth it out? some sort of short-term pattern recognition, mean reversion, carry trade, it'll make it so much better. And I'm like, no, I'm too bored with those, and I don't want to waste my time with that, especially if it's negative skew. But I do trade shorts, so that's my one sacrifice. So I'm trading something that primarily helps me just tolerate the long positions and makes in the performance and the ability to live with it is so much better if rather than trading longs only. So that's my sacrifice. I will trade a crappy idea that really doesn't make money over time, or some of the alternatives to trend following that we looked into over the many years, they actually helped the trend following. They just lost money, but they were great to have on when trend following did poorly, but they ended up not being a positive contributor. So look, at least I'm doing something. The shorts make a small contribution, and it's not a negative skew. So yeah, I love the shorts. I think one of the first things about money management and risk control and preserving capital is you're going to have an easier time doing that when you have longs and shorts on, not just mostly long. And I'm not talking about just sectors either. Obviously I'd like to have some uptrends in some bond markets, so I could offset these losses in the short positions this week. But it's, I think still being long some commodities and some stocks is helping. It's always good to sort of be somewhat balanced. Unfortunately, there's no way to do that discretionarily or optimize the systems that I've ever found to optimize the systems to where you have a tendency to have longs and shorts more equal amounts than, but I've never done that as a project either. But I think that would be a good project if you could kind of come up with a trend following strategy that was hunted the outliers and made lots of money and was really a good strategy, but somehow you were able to figure out a way to not blow your sample size or to minimize your profits, that was also had a tendency to be more balanced between longs and shorts, because that really is the first line of defense. And that's why we do so much better than so many other strategies, because sometimes the only thing out there are the shorts to protect yourself and to make money.
Yeah, that's very interesting, Jerry. And what Trading Mentor was talking about is also interesting in that, I often find, for instance, on Neil's podcast, he often refers to this concept called heat, which is the maximum risk exposure if everything in your portfolio suddenly immediately went towards its exit or its trailing stop. And when I look at my portfolio, and I take, for instance, an example of some of the outliers I'm writing, like spot crude and Brent. I'm predominantly long with my my trend following systems. I'm using 6 different trend following systems. I'm predominantly long, but what I do find is that events such as what we've experienced over the last week or 2 weeks means that some of the shorter term models, or the models that have triggered on the shorter term signal, are now short. So previously, where I might have had all 6 systems firing on the outlier, now there are 2 systems that are short and 4 systems that are long. And from a risk management perspective or a heat perspective, you're less worried about your total portfolio heat, because you've effectively got 2 of your positions hedged against 4 of your other positions. So there's a degree of hedging going on, and when you combine both long and shorts, you do get benefit. It's hard to see, but you often find at the worst times where you're feeling most exposed, there's something protecting you in your portfolio because you've got both longs and shorts.
Yeah, I listened to this heat conversation, and I think that it's just there's better ways to go about the heat and how much risk you have from current equity to the possible drawdown, or the max to the possible max drawdown. because you gotta be careful to put the most important things in the correct order. And of course, the most important thing starting out is don't trade too large. Have a tendency not to get yourself into a really hot, heated situation like this because you trade moderately, right? Number one, you're not going to be able to trade large and then come in one day and say, I'm going to cut back everything because I'm guessing now would be a good time to do that. So if you're overtrading, you're going to get your ass kicked one of these days. You're going to run into heat all the time. So stop doing that. And then number two, what's this? Another a principle that may stand above all other principles. This heat idea violates this principle, and that is do all the trades. Don't miss a trade. Take all the system trades. It's elementary. There's no one who has ever looked into trend following for 15 minutes who walks away without knowing, oh, you just have to be super disciplined and follow the system and do all the trades. I can do it. It's easy. And of course, when you start trading, you realize it's not easy. But no one argues against that. However, they'll say, well, if I have too much heat in the portfolio, too much risk, too much open profit, I will do a non-system trade. And I will get out of some stuff or whatever. I'll move the stops up. I'll do something based upon the heat, but not based upon the back test of this is the system, this is my entry, this is my exit, this is my stop loss. So you're violating. And then the excuse is, if you call it money management and risk protection, you can do whatever the hell you want. And I'm like, no, you can't. You're not following the system. And I've been misquoted on this concept so many times, but I'll continue to pretend like it's worth what I'm saying and people are not going to continue to misquote me. However, if you trade small, if you're totally dedicated to doing all the trades and letting your profits run and accepting some heat, because that's what we have to do because we're letting our profits run. Once in a while, once a year, once every 2 or 3 years, I think it's perfectly a great idea to say, hey, this is way too much risk. This is COVID, it's February 2020. Things are blowing up. All hell is breaking loose. I'm going to reduce my positions across the board and reduce my trading size for a period of time to preserve capital, to stay in the game. This is a one-time universal rule to say, this is not a daily dose. This is not me checking my portfolio daily, trying to do a trade that reduces heat. No, this is a trade once a year, once every 2 or 3 years, that I'm admitting to myself, I wish I didn't have to do this. Maybe I should have traded smaller. I am not doing a system trade. I'm dedicated to doing all the system trades and only doing those system trades. So yes, I will do this cutback infrequently, hopefully never. And some people trade pretty small and they never do them. That's great. But yeah, what do you think? Give me some good feedback.
Great points, Jerry. And that's a topic for tomorrow if ever there was one. So hammer home the discussion about heat tomorrow.
Hey, Jerry, have you ever increased the size of a short position in order to preserve the magnitude of the effect it can have on a portfolio? Seems like if you size positions the way you do a classic trend follower would, as the trend progresses along, that market has more effect on the portfolio. And on the short side, as your position gets smaller, it has less of an effect. Have you ever increased the size of a short or ever wanted to let it keep doing its thing?
Yeah, good question. I don't really understand. I've heard people say that, and I don't really understand that idea. How I look at it to where, I put a long on, it goes in ATR. I put a short on, it goes down 10 ATR, and I make 10 ATRs on both trades. So I don't understand this. I never understood this concept because I've heard it many times that somehow the short gets smaller, and I don't understand that. I don't look at it that way. But you bring up a very good point, because what really hamstrings us to a large degree is on the shorts is a systematic approach that uses ATR, because sometimes these markets can go to zero And if you base your size on ATR, if it goes to zero, you're not going to make that much money. And it's probably not going to go negative very often, like the crew did. So you kind of know ahead of time that it's not a great trade. And then you read some story about some long short guy who made all this money short some stock. And I look at it and I say, well, darn, if I would have shorted that stock at that time, I would have had such a small position because the ATR was fairly large. So all he did was he's not using systematic and he's not using the ATR. He has a gut feel or some non-trend following systematic way of sizing that of deciding to do the short, then basing the short size on his conviction, where we base it on the ATR. So we're hamstrung in that regard on shorts. And I'm always like shaking my head, like, why can't I make more money on these shorts? And it's really because the ATR limits the size of the trade, and I'm dedicated to using that same formula with all my trades. Go ahead and comment on that, because explain to me this whole idea that I don't understand of how shorts get smaller. I don't understand that.
Well, I mean, if you go long a market and it doubles, you make 100%. If you go short a market and it halves, you don't necessarily make 100%.
Yeah, but
It's
my whole money management scheme is based around ATR and not percentages. So, like I said, I just look at it as I made 10 ATRs on the long, I made 10 ATRs on the short, or 50, or lost 5. I don't look at it in terms of percentage, and then I don't. No one trade is going to have a material impact on my trade level calculation. So that's not going to really, unless it's a monster outlier, and that'll only be after the fact when I recalculate my trade level based upon closed trade equity. Yeah.
Yeah, I mean, I'm with you. I do the same thing. As you were talking, I was just thinking, if you get into a short trade, once your trailing exit has surpassed your original stop that you've sized the position on, and I haven't done any work on this, maybe it's something that can be looked at, but maybe once that trailing stop is in place, you could then maybe resize your position to where if that trailing exit is hit, the amount you would lose could be, recalculated to your original stop level or something like that. I don't know. I'm just kind of thinking out loud.
Yeah. I've thought a lot about shorts. Obviously, that example violates one entry, one exit, one stop loss, and treating all trades the same. So that would be a no-go for me. But yeah, I've never read I've read a lot about traders talking about their trades, and I tend to focus in on some of the shorts. And most people say they don't really make much in the shorts, although there are dedicated short sellers out there. So once again, I think you have to look at things from a fundamental balance sheet, income statement point of view, maybe, and then just take a position without regard to ATR. It's just such a different ball game. If someone came up to you and said, "Hey, I have an inside tip. You should short this stock because it's going to go low," and I can promise you that you won't be arrested for acting on this insider tip, insider trading, then you'd sell as many as you could, and without regard. So I think that's how you do it, without regard to proper systematic trend following, risk management, position sizing, ATR, the whole building block of everything we're putting together. You could probably make the shorts better, but then what situation are you in? You're in a bad situation.
It seems interesting. We think so binary with long and short when it comes to like stocks or bonds, but in currencies, you're always long and short something. And with really any market, you're long and short something. Anytime you you go along something, you're swapping it for something else. And maybe we need to not think so binary about it and think, what are the chances? I mean, really what you're doing is you're just making a trade based on the assumption or based on the probability that whatever you're swapping for is going to do better than what you're swapping out. It'd be interesting to see if you based a trend following system in a different currency, maybe instead of US dollars or maybe a major currency, if you based a trend following system in a currency that's done different to the dollar.
Yeah, I like that idea, Seth. And the only exceptions to that rule are things like indexes and ETFs, which are constructed vehicles that you might invest in. But aside from that, yeah, I agree with that principle entirely.
We need to have I need to write a paper, or I need to have a podcast and talk just about what Seth was mentioning about putting trades in other currencies and trading cross currencies and trading futures markets that are not based in your own home currency. It's quite a little puzzle, and I've worked on it for my entire career, and there's some nuances that unfortunately don't make it a holy grail to do that. I do think that if you denominate crude oil or all your commodities in another currency, I think that's doable. I think it can work. It's going to not be very material, except it will give you, I think, a bit of diversification, entries and exits. Something that's crude denominated in the dollar, it may fall down and get you stopped out, and then crude denominated in Canadian dollar may just have missed and exiting and goes back to all-time highs. And so that level of diversification that we like, and we primarily get from trading a lot of different markets, or in that example, it sounded like it was more of trading different entry and exits breakouts, then you get another layer of that type of diversification by denominating it in something that other than your home currency, which people who don't live in the United States, they're like, dude, I do that all the time. I'm in Europe or Australia or wherever, Asia.
You're making me laugh.
Yeah. And they're like, when you Americans think about the rest of us, we have to trade all of your markets and we deal with this crap. And the problem is, you see, this is issue one. There's like 10 issues. I've made spreadsheets and written code that you can pretty much type in. You can pretty much ask the computer any sort of scenario of what you're going to go long and the currency you're going to replace the dollar with. And it'll walk through all the different scenarios of what your P&L could possibly be. But the first issue that we all face when we trade like like when I trade the Bund or the any market denominated in the euro, when the market goes up, when I have a trade that the computer says you made 5 ATRs on this trade, when you actually do the trade, you don't make 5 ATRs. You could make 4, or you could make 6, or probably 4.9 in that scenario, or 5.1. But you do have this slippage, and the slippage can get better and worse, materially different over time if you hold a trade for a year or two. As the euro continues to collapse, theoretically, you should have made 20 ATRs, but you only made 15. And so that slippage is figured into obviously into the real world, and it's not as easy, because when you exit that trade, you have to convert that currency back into your home currency, and you've got that P&L to worry about. So that could play havoc in the back test. And yeah. So, and another principle is that the bigger the profit, the more slippage. So the more you make on those type of trades, the more slippage you have. But the more you lose, the less slippage you have. So you're like, oh, great, I don't have a lot of slippage, but I didn't make that much money. Oh, darn, I made a lot of money on this trend, but when I converted it back into dollars, I made a lot less than I hoped. So that, in a nutshell, is how the issue works. And unfortunately, I have spent a god-awful amount of time, measured in years, on this sort of project, because it is kind of the holy grail. Can you switch out the dollar for something else? It could be another currency, it could be anything else. Can you trade these spreads, these crosses, define them ever how you want? But they're tough to get a hold of because of that idea that denominator that you've just chosen is really going to move around.
This is actually a fantastic point, and it's very interesting what you're saying, because it seems like, what I remember a couple of months ago, you were sort of posing a challenge for all of us on how to compute ATR using only one, or not using open, high, or close, but using only as few prices as possible. And one of the ideas is just if you extend your window, which is what you do, so far, then you can almost use one price, because that's the daily fluctuation almost don't matter. And again, it seems like this should apply to currency fluctuations, but what you're saying is it completely doesn't. There's a strong currency effect, which is very interesting.
And of course, the other thing is, at the moment, I'm transitioning my portfolio to a fully hedged portfolio to the original currency denominated market. So I will actually start trading Swedish index in Swedish krona rather than in British pounds. And of course, the question is always, well, what is going to happen in the portfolio? You're going to end up with lots of indices that are denominated in European currencies, like the euros and whatnot, the Norwegian krona, the Danish krona, and whatnot. And the question is, would you like to hedge that FX exposure at some point, or would you like to just run it, or when you're trading something else in Asia, so it's a Japanese yen exposure or the Aussie dollar exposure, and so that's another challenge, whether you would want to implicitly end up with the FX exposure in your portfolio, or you rather actually dissect it and end up with the real impact on the price. And that's, I think, another decision to be made at the portfolio level. Thank you.
Yeah, good.
Yes.
That's right. Really good idea. And so I've thought about that, and it's work and it's technology. And the way I thought about it was, if I'm short the euro, then I'll hedge. If my system is short, but if not, I'll just let it ride. And so I think you can do it a smart way and try to hedge out. So, I'm already short my euro position, and I'll short a bit more based upon if I'm long, something in Europe that's denominated in euro. So, yeah, I think that's pretty unique. But when you create these synthetics, I'm going to create something. I'm going to this soybeans divided by the euro doesn't exist. I want to create this because I think it'll give me a slightly different chart pattern, and it may get me out quicker or keep me in longer as compared to the soybeans in dollar terms. Well, you can't hedge that because that's back to the US dollar. It's back to the original soybean contract. So it's a pretty fun concept.
Yeah, you just got to be careful that if you denominate in all the same currency, then inherently within the portfolio, you're going to have a much more correlated portfolio than if you deliberately break that correlation structure through the choosing of denominated markets that break down that inherent correlation that exists there. So yeah, it's a really sort of theoretical, exciting sort of thing to dig deep into, but I can see why you'd spend years on it, Jerry. It wouldn't be easy.
Well, I remember getting some research one day, and I wanted to look at all of the trades, and we had put all the commodities in terms of the euro, and the results were not that great. And so I wanted to dig deep into individual trades. So I looked at the most profitable commodity trade of all time for our systems, and it was this. I think it was like long lead. I don't even remember the dates, but let's just say it was long lead, and tremendous trade. Okay, so then I looked at that same trade when we had put it in terms of the euro, and it was not nearly as profitable. Not nearly, because then I looked at the euro, and the euro was in a tremendous uptrend as well.
Jerry, when you do such analysis, do you have ability to pivot on all your trades in different methods? So, for example, every day, at the end of trading day, I try to tag my trades with various facets. So, let's say if I want to study how's my performance by strategy or sub-strategy, right, within the core satellite portfolio, or is it specific country allocation? Is it specific sector allocation? Is it specific market allocation? Or is it specific strategy allocation, right? Do you also do something similar? And if yes, what kind of factors do you use from a standpoint of studying the effects or studying your past trades and the dimensions that you studied by?
Well, that sounds a little bit out of my pay grade. I had really good people on staff that did the back testing, and the math experts and computer experts created synthetic data as if you could actually trade these commodities in terms of other currencies. So
Got it.
I guess my point was that for an American who gets rid of the dollar and goes into the euro and then goes long that lead, they're going to make a lot less on some of these outliers because the euro was appreciating as well, and we were short the euro essentially. So and if it gets in the way of these outliers, then I think that's the problem, and that's how you can hone in on it. Like, you start doing a lot of work on this, and you just go and look at your top 10 trades of all time, and in dollar terms, well, how did those do in terms of this other currency that you're planning on maybe using? And so if it's not measuring up, you need to stay away. And that's what we started to find, that we were making money just sticking with the currency and not trying to get too fancy with what we would call kind of spread trades, essentially.
Got it.
Hi guys, just wanted to say that first, I'm a shorter term trend follower than you in general, and it's been a bad month also. And about shorts, I'm looking at the Argentina's market, which, for example, for the sovereign bonds, it's like 50% down on the year, and yet this week the bonds rebounded 30% in just 5 days. So you're right about the dangers of shorting if you look at them in a single instrument or single trade way. But I also think that they are useful for trading some kind of economic scenarios, especially in my mind comes the deflationary scenarios, because if you can short some instruments, like for example commodities, you have much more choices than somebody who's just using the long only instruments. So I agree with you in terms that they're in the end to use them.
One thing this discussion is pointing out is that really there's no end to the possible level of diversification you can achieve, because if you run out of the traditional markets, using these synthetics is a way to possibly expand your diversification principles. So that gives me a lot of joy to think that it's virtually unlimited the amount of diversification you can achieve, provided you can assess the degree of correlation of that diversification at the portfolio level. So ideally, you're looking for the least correlated structure.
Yeah, and in the case of the Argentine trade, the fact that it's so volatile and it was small, if you got hammered with that 30% rise in a week, at least the size of the position that the system made you put on the market was small also. So it's useful. Maybe it's bad in terms of not recovering fast from a down market, but it's protecting you if there are those kind of bearish rallies.
So Cordura, in those kind of cases where the realized vol is so high, right? Typically systems tend to not allocate more than 10, 20, 30 basis points at the most, right? So your downside is limited. Of course, your upside is also limited, but that's usually my observation. If anyone has any other thoughts, please share. I actually choose not to trade in that specific market.
No, I don't either, because it's virtually impossible in terms of credit and the instruments. I mean, it will be very, very hard, and in the worst moment you will run. Nobody will put any bid or ask on you, but
good. And also, in case if you end up allocating anything there, the overhead to just getting things done is so high, you can't easily get it done. So it's not worth your mental bandwidth.
Yeah, but if I was trying to put the chart here, but if you see the chart, it's a sovereign bond that went from 100 to 17, and then rebounded 30% from that. So it's like, how many ways do you want to go bankrupt? It's giving you all the possibilities, and then again, if you are shorting it, if you are able to short it, the sizing, the automatic sizing of your ATR methodology will at least protect you somehow.
I don't think that applies at all, because it's, first of all, one wouldn't get an easy borrow on that. Second, if you're trying to get CDS, the CDS markets also they don't exist for that market, right? So I don't know how exactly you'd express your short, especially in that market. Inflation is kind of 92%. Bonds are useless, right? So I just choose to avoid that market completely. And it's not, if it's not implementable, then I don't even discuss it, right? I just move on.
No, but the point is that if you see the curve, the price chart, it will be very similar than many other things that are tradable. In respect to this conversation, I think it was a good example, even if at the end of the day you cannot enter that trade.
Yeah, you'll find 20,000 such examples in crypto, because there's 20,000 coins, right? All of them have similar characteristics.
Yes, you're right. And sorry, regarding to the currency issues that you were commenting, Sherry, in a way, isn't it similar to having to have adopted a currency basket if you don't hedge the currency of each market? I mean, a currency basket for your accounting and for your NAV.
Yeah, that's right. So you have these small. I keep wanting to say non-US, but you have these small balances: Canadian, Australian, Euro, Pound, Yen, China, for your margin and P&L, and so they're all out there. And then, of course, when you get the P&L from these, when I get them from these non-US trades, I have to when to convert them to dollars, and so we're always faced with these accounting issues because we trade worldwide in many different markets that are in different currencies, but certainly you can make that problem and that issue much larger by creating synthetic markets with different currencies. But I have to say, it is material in some big trends as well to make less in a trade because of the currency fluctuation. And I've seen that happen, and it does happen. And it's probably a good argument for more active currency hedging on non-home country currency denominated markets, especially if, like now, if you're short the yen, you probably want to hedge out some of your yen exposure. If you're long a market denominated in yen, but I don't think I am, so maybe it's not a problem now. But I will say in the back testing, it is a major issue to get this correct, and when you're not trading markets in your home currency, I'm ripping this research reports off the printer and I'm saying, oh, okay, my average trade is 3 ATRs, 4 ATRs. Well, is it? Because did you figure in that slippage having to be in another currency and then convert it back to your home currency? So I think that is a major research back test idea. The more and more we all expand into different markets.
I think that too, and I think that especially the part of your margin that has to go into another currency is kind of a risk or an allocation that you don't want to have. In terms of the rest of your exposure, I think I don't know. I'm not clear enough in my thoughts, but I think that the movement of the currency, for example, in a foreign bond, it is part of the price in the sense that it's a whole economic system, and what the currency does affects the price of the bond. So if you're writing the bond trade, you're writing all the factors that apply to that bond, and that will include the currency. I'm thinking out loud. I don't know if that's right or not.
I was just thinking about this spreads and the slippage. Now, if you're trading hourly bars like I do, then actually modeling the spreads and slippage are pretty important. And so I usually call this slippage as an implicit cost to the trading. They are not explicit like the other costs that you pay to the broker.
Yeah.
But you need to come up with a way of estimating that slippage. And now I'm trading like 7 months now, so it's still less than a year. And my history to be able to, I'm tracking how much slippage I'm paying on these thousands of trades that I'm doing, or let's say the computer is doing, to be able to end up with an estimate. And of course, if you're trading years and decades, you will have a better idea of what that slippage cost is going to be in your portfolio. But it is absolutely critical to be able to come up with an estimate, especially if you're trading those hourly bars, because if you don't estimate it, if you don't put it into your backtest process, then you're just dead. The entire spread might just get you out of the business. So it is something else. So on the short end, I do everything else like the long-term trend followers. But when it comes to the costs, then the estimating the spread and the slippage is an additional process that I apply to be able to ensure that these costs are not taking me out of business, basically. Thank you.
Yeah, and they can be a source of alpha too. So if one can model it out properly, then implicit costs such as beta spread, market impact, especially if you're trading all the bonds and if some of them are illiquid, then delay, right? So for example, when did you get the sale versus when is your system actually being able to place the trade, etc. These kind of implicit costs are absolutely important to model and be minimized. Now, delay you can take care of through systematic strategies because you're going to put it in your code. But from a standpoint of beta spread and market impact, it's absolutely important to study. That's why if you look at some of the funds such as Renaissance and few others, this is a reason why they get the order of over 7 or 8 terabytes of all markets combined every day in order to process it so that they could model out some of these costs. Now, this can become extremely tedious effort, but for whatever markets you trade, and if you decide to go fairly larger in size, execution cost optimization is absolutely important. Or you could use some good execution venues if you want to abstract yourself out of that, but keep in mind that these kind of implicit costs can
Exactly. It's not about eating your alpha. It can take you totally out of business. So
well, it will take you out of business if you're in high frequency trading, right? But if you're trading trends which are multi-day, multi-month, then I don't think it will take you out of business.
No,
Jerry, what are your thoughts?
It won't, but you would need to be careful on what you're doing,
Of course,
especially if
of
you're
course.
executing thousands of trades on an hourly time frame. So and I'm sure this thing is going to be wider because, for instance, in this group there are not many people who's actually raising hands and saying that I'm trading hourly bars. As far as I'm concerned, I'm out there. I'm a new trader, but trading hourly bars with an automated process. And the more people will come to this space, then brokers will end up providing more data to be able to estimate this implicit costs. Because surely you are a long-term or medium-term trend follower. You're really not much concerned about your implicit costs anyhow. Thanks.
Right, but trading mentor, the point is that if you're doing that kind of trading, you're not going to go through a direct. You're not going to use like a standard broker like a TradeStation or whatever. You're going to use a DMA, right, a direct market access. So
yes, so that is
yeah.
I agree with you.
Yeah.
So which broker you use is part of your analysis. Okay. So I'm not using Interactive Brokers, so which is one of the best brokers to use as an algo trading, but I'm living in London, so I'm using another large one. So it works, but it's still, my broker is not providing an analysis platform for me to be able to estimate the spreads. But I know that there are some brokers for institutional type traders who are doing what I am doing, and they will be able to leverage out that information. And I'm hoping that it will be widespread available in the future, because it's just a cost, like any other cost. Why we are keeping it esoteric, why we are keeping it hidden, is totally another conversation. Thanks.
Yeah, and I would encourage, if you're interested in that sort of information, on Google Scholar, you can find a bunch of papers which are related to implicit trading costs. So definitely go through them. Some of the folks who have had access through their research for order book data, they've made some fascinating research and shared some of them. Of course, it's not of the same grade as some of the HFT research I've seen, high frequency trading firm research that I've seen, because they tend to trade at milliseconds in the order book across multiple exchanges as well as dark pools. But what are research you can see in academia or otherwise is also pretty impressive, and you can embed some of that in your trading. Now, I do want to step back from this because I do have some hourly trading strategies as well from a trend following perspective on a very, very short term time frame, but I don't allocate more than 5% of my capital to that. So I'll step back, because in the interest of the trading club, if there are the topics that are of interest, then I'd like others to share those.
Oh, that was great. Thank you. Thank you very much. That was insightful, and I always like to hear other thoughts and other things other than our core long-term trend fund stuff. So, well, unfortunately, as I said, I had to get off in an hour and a half, and got to go talk to my friend Niels and for the podcast Top Traders Unplugged. So I'm I'm 100% sure that this recorded. I think it's partially Twitter and Spaces problem sometimes, and partially sometimes it's my problem. But I think they're trying to make it easier to record and not screw it up. And I did not screw it up. So this will be recorded. We'll post it on Rich's website, and then Twitter will automatically have a copy of it as well. So until next week, I wish everybody a good weekend and happy trading, and see you back here next Friday. Thank you, everybody.
Thank you.
Best of luck with Niels.
Thanks.
Bye, everyone. Bye.